Hi, and thanks for tuning in to Chapter 18. We're going to look at inventory and overhead. Some of the terms you'll need to know are perpetual and periodic method, two ways to calculate inventory, or I should say times. Overhead, what is overhead, such as rent or taxes, expenses that can't be specific to a department, but it's as a business in a whole. Inventory turnover, and what the high and low ratios mean. So, well, let's look at the four ways to calculate our specific, kind of what the businesses use for inventory. Now, to get your ending inventory and your cost of goods sold, there are specific steps in each of them, and we'll actually walk through them on the practice problem of learning unit 18A on page 437. So, but first, let's cover the specific identification. You're going to get the most accurate. This could be the most time-consuming depending on what type of widget or vehicle or business you deal in. But what you do is you figure out your cost of goods available, and also you calculate your ending inventory. You subtract those from each other to get your cost of goods sold. Now, weighted average is a little bit different because you take the average units you sold at the total units you sold, the amount of cost on the average to calculate it, and then you do your same cost of goods available and subtract your ending inventory to get your cost of goods sold. So they also use two terms, FIFO and LIFO, first in, first out, last in, first out. And that just means it gives description of when the product was sold, which product was actually used from the shelf. So if it's first in, first out, so if we received a shipment today, it would be the very first thing we got off the truck. If we sold something, we'd give them one of those products. Now if it's last in, if we got a shipment yesterday and a shipment today, we'd actually use the last inventory we have, and it would be the first to go out. So that way we wouldn't have some canisters or toys or whatever it was that we're producing sitting on the shelf for years because we just sell the first allotted amount of inventory. The best way to do this, besides describing it, is to walk through a practice problem. So turn to 437. We're actually going to look, I didn't write down the stuff, but I will read it out loud, and so you can follow along. So it says, calculate cost of ending inventory and cost of goods sold under weighted average, first in, first out, last in, first out. And so what we're going to do is, looking at above, we're going to calculate this. So to do our weighted average, we actually have to figure out what the price is per unit. And we see that the totals for what they sold of books equals $810. And when you add up the number of books purchased and sold, it's 170 books. And so, if we do that math, it looks like it's going to be $4.76 a book. Okay? Well, now they tell us that the ending inventory, so the ending inventory is 58 books. So we just do 58 times our $4.76, and we get $276.35. Two ways we can calculate cost of goods sold. We can just do 800 minus 276, and we get the cost of goods sold of $533.12. Or we can actually reverse that and do 170 minus 58, and that should be 112 times 476. So there's different ways to do it, and I think actually this should add up a little bit differently. Rounding in the calculator, 65. And my pen's going, even better. Well, now let's calculate first in, first out. So if I'm doing it that way, when I have my ending inventory of 58, I have to figure out, okay, if it was the first in, then there's the first out. So we used 112 units of January, March, and April. So we have 50 units of November not used and 8 units of April not used. So we've got 50 units at $7 from November, and then we have 8 units at $5 from April. So our ending inventory is going to be $390. We subtract that from $810, and we got cost of goods sold, $420. Now let's switch that around and do last in, first out. So that means the last that was in is going to be basically January. We're going to have January all used up because we have 58. And so we have all of the $80 from January from the 20 units. And then 58 minus 20 is 38 units. So 38 units at $3 equals 114. So this is 194. So 180 minus 194 equals 616. So these are the different ending inventories. And if you notice, our weighted average fits in between the last in, first out, first in, first out. And that's normally how it should be. So the second part of the learning unit, 18.2, was on the retail method, as well as gross profit method, inventory turnover, and overhead. So the retail method, what you do is you calculate the cost of goods available at cost as well as at retail. Then you figure out your cost ratio, which is just the cost of goods available divided by, or at cost divided by cost of goods available at retail. And then you subtract your net sales. You subtract from your net sales your cost of goods retail to get your ending inventory at retail. And then to get your ending inventory at cost, you basically just multiply that by the cost ratio. So again, hard to chew through sometimes, so let's work one out. So let's turn to learning unit 18-2A. So our beginning inventory is $19,000 at cost. Our retail was $60,000. And then we have our net purchases at cost is $265, and $392 is what we had. So let me do the math real quick. So 19 plus 265, so 284. Whereas this one's going to be 452. So my cost ratio is 284,000 divided by 452,000, which is 0.62831. So our net sales is 375,000. So I do subtraction there. I get 77,000. Now that's my ending inventory at retail. I'm going to now multiply that by our cost ratio, 0.6281. So I've got $48,363.70. So that is my ending inventory at cost. So next we'll go into gross profit. There's 4 things you need for gross profit. For the gross profit method, you need your average gross profit rate, your net sales at retail, your beginning inventory, and your net purchases. So here is what we will do and how we'll walk through it. We'll calculate our cost of goods available. How we do that, beginning of inventory plus our purchases, which we've done previously. And we take our net sales times our cost percentage, take our estimated cost of goods sold. Then we take that ending inventory and we take our cost of goods available minus our estimated cost, and that's how we calculate our ending inventory. So number 2 of extra practice problem 18-2A says we begin, and these are the numbers that they give us, we begin with 30,000, net purchases of 8,000, so we have a cost of good available of 38,000. Our net sales is 8,000, or actually net sales at retail is 16,000. Times that by our cost percentage, which is 1 minus our percent, so 1 minus 0.3, so it's 0.7. So our estimated cost of goods sold is 11,200. And so our ending inventory is going to be 38,000 subtracted from our 11,200, which gets us 26,800. So one of the formulas that they actually have also in there is your inventory turnover, which is basically your inventory at the retail rate, and then your retail rate at, or your inventory at cost. And these have 2 different formulas. Your net sales divided by your average inventory at retail, and then your cost of goods sold divided by your average inventory at cost. So we can do a quick example of this, number 3 of the practice problem. So obviously I'm just going to put my numbers, my net sales at 129,500 divided by 21,800. Our cost of goods sold is 76,500 divided by 11,2. So I just plug in the math. So this is 5.94, and this is 6.83. Our last one is just overhead. How do we calculate overhead? 2 ways, by doing it, looking at floor space and then looking at sales volume. Floor space, you take the area of that area divided by the total area times the total overhead. Same thing for the sales volume. You take your department sales divided by the total sales, you multiply that by your total overhead. So if we look at the final practice problem, it says figure out the departments, one of 10,000, one of 50,000, with an overhead of 60,000. So 10,000 over 60,000, because 50 plus 10 is 60, so the whole building is 60,000. Well, these can actually cross out, and so Department A has $10,000 of overhead. And then if I did it the other way, it'd just be 50 over 60,000, so 5/6 times 60,000, so it would equal $50,000. So it's relatively simple. If you have any questions, feel free to email. Thanks. Take care.